Hello and welcome, social media, to SIkich Live. We are back, and I am your host, Mike DeGeeter, coming to you from sunny Chicago, Illinois. If you haven't heard of us before, we are an accounting, advisory, and technology business consultancy helping to digitally transform the world that we all work in. Each week, SIkich Live comes to you with the latest and greatest in business applications, including ERP and CRM, managed services, cybersecurity, IT, infrastructure support, and so much more. So make sure to tune in each Thursday at 2:30 Central Time. Before I bring on our guests for today, I do want to remind everyone, though, do not be shy on SIkich Live, of course. Add your questions and comments, and they may just be featured on today's episode. Okay, well, let's just get right into it. Today's topic is standard lease changes for equipment manufacturers. And our presenters today are Debbie Altham and Sylesh, both from SIkich here. Hi, Sylesh, how are you?
Doing well. Thank you, Michael.
Yes,
hi, Debbie.
Hi there.
Thanks for being here with us today. We are excited to have the both of you. And for today's SIkich Live, I am going to give control right on over to Debbie, who will be taking care of the question and answer portion here. Thanks again for joining, and I'll see everybody in a little bit.
Okay, and thank you, Michael. So the topic today is quite interesting for me. I'm a recovering accountant. It's the scenario where you're at a party and there's these questions you want to ask, and you manage to corner this person who's a real accountant to be able to ask them. So really lucky to get Sylesh to be able to work through some of these questions I have. We at SIkich do a lot of work with equipment makers, people who manufacture equipment, and we maybe call them OEMs, people who make that original equipment. And there's this, I was on a call with our manufacturing vertical group the other week, and they were talking about the lease standards. And my ears picked up because, I understand that there's operating leases and there's finance leases and there's ways that our clients can sell their products to their customers, which may have an impact on how their customers account for those products. And I was really curious to find out, is there going to be an impact for our clients who are making equipment in their sales cycles where their customers are going, I want to buy this, but I want to keep it off my balance sheet. So in comes Sylesh, because I think he has some answers. Let's start out from the top. Operating finance lease, what are these lease standard changes to start off with?
Sure. Thank you, Debbie. Great question to start off. The two new standards, right? The old standard is ASC 840. The new one is ASC 842. In the old standard, we had two classifications, right? We had operating lease and capital lease. In the new standard, it's again two classifications. Instead of capital lease, we have finance lease and operating lease. The big change, Debbie, what happened is historically, the OEMs relied heavily on supply contracts. And one of the main purpose of drafting the agreement or lease agreement or supply contract was to see if they can park the asset out of the lessee's balance sheet. So mostly it was operating lease, which need not be parked on the balance sheet, and only capital leases had to be carried on the balance sheet. The new standard require both operating lease and finance lease to be carried in the balance sheet. So that's a big change. And I think all the lessees, it would be a significant change for OEMs and the part suppliers.
So when they are trying to sell, pieces of equipment that are high value maybe, or even lower value, they've been typically having some angles to be able to sell those to customers who don't have to put them on their balance sheet. Mm-hmm. And those doors are closing with this new standard. Tell me, I know there's some before we go much further, there's some effectivity dates for this standard. So when does this start? And I know it's different for publicly traded than privately held. So can you talk a little bit about the timing of this?
Sure. So for publicly traded companies, they've already implemented the new standard, effective 1/1/2019. So they are 2 years into this new standard. For privately owned companies, there were a couple of deferrals over the last couple of years. Now it is applicable for fiscal years beginning after December 15, 2021. So effective 1/1/22 for calendar year private companies.
Okay, so this is pretty imminent, obviously. What I'm really interested to know about is the impact on the sales conversations that our clients are having with their customers. So, before they would say, we can structure your purchase of our equipment this way and you'll keep it off your balance sheet. Or we'll structure it this way and you can put it on your balance sheet. So, we are tossing around terms like, maybe we do structure it a different way and that'll allow you to keep it off your balance sheet. Maybe we do a rental. Maybe the way we do a rental could get it off your balance sheet. And then maybe let's think of the rental side first, if we could, just understanding how that works.
Sure. So, like I said, I think there's no way out. It looks like pretty much because operating lease and finance lease is required to be carried on the balance sheet now. The only exception is the lessees could elect an accounting policy for short-term leases, which means any lease with 12 months or less in duration, provided the lessee do not have an option to buy the equipment or the asset after the 12-month lease period, and it's highly likely or very likely that they would exercise the buying option. So, and again, even this is an accounting election that a lessee can do for short-term leases, that they don't have to carry that in the balance sheet. All other leases, Debbie, like even though it is an operating lease, because historically that is what with 840, the supply agreement or the lease agreement was so phrased or designed that way you can park it outside the balance sheet, right? So now that option is not there. So again, you see whether it is operating or finance lease. Both finance lease and operating lease will have the same impact on the balance sheet, but in the P&L, it will have a different impact. So if you have a finance lease, your P&L would have a higher expense during the early years of your lease, because interest expense is a significant part of the expense that will be recognized when you have a finance lease. So in the balance sheet, it will still be carried, but it will have a P&L impact if it's a finance lease or an operating lease.
So one of the other more creative ways that our OEM and equipment manufacturing clients are looking at going to market is equipment as a service. And this is enabled by all this new technology, right? We have Internet of Things. We have all of this great new technology which supports this new business model. And the business model sort of positions like, we were talking about an example of a company who makes coffee machines. So instead of, I make coffee machines, I'm the OEM, you can have my coffee machine, but instead of paying me the $15,000 it's going to cost you to buy that coffee machine, you can instead pay me in a sort of a loaded up cost, which covers maintenance and consumables and service and all the rest of it, as well as the cost of the machine at, let's say, 20 cents a cup that you pull from the coffee machine. So in that scenario, the way that we were looking at it was this was great for your customers because it could potentially pull that off their balance sheet as well. So tell me what would happen in that scenario for equipment as a service?
A great question, and I guess the subscription economy, right?
Right.
The service business model. basically, I think from what you're saying, clearly they want to enjoy the benefit of an asset, but then avoid the burden of ownership.
Correct.
So yeah, I think there are some options if you think about it. If you design it um, uh, in a right way, you could escape. Again, I don't think it's a wide open door, but in that situation, Debbie, what will happen is it will depend on who has control or the decision making power about, say, what, when, how it will be used. It'll also depend upon whether the service provider has a significant, say, substitutional right. Like they could substitute the equipment or asset according to their discretion. Like um, plus, by substituting it, the supplier has an economic benefit out of it. So there is a lot of factors to be considered, but that's a very interesting, um, I guess, model that the OEMs should pursue and see if there is an option to educate their clients and see if there is a way to design or consider equipment as a service as an option
Right.
to park it outside of the balance sheet.
Right. And at risk of turning an educational session into an advertisement, I'd say we've probably got the right people here at SIkich to help an organization try and navigate that, right?
Yeah, we do. We do. In fact, we have at SIkich a ASC 842 implementation team that could help our clients and prospects in various ways. Sure.
So we've been talking a lot about the we'd prefer to have it off the balance sheet, we'd prefer to have it in our P&L, but is there a way that our OEM and manufacturing equipment manufacturing customer clients can alleviate some concern that their customers are having over, is it better on my balance sheet? What are the kind of considerations a buyer of this equipment would have, and what's the benefit of putting it on their balance sheet versus the benefits of putting it on their P&L? I mean, I guess there's tax implications, there's probably business valuation, there might be covenants. Yeah. Can you sort of talk a little bit about what sort of things that the reasons why a customer would be okay with having those costs in their balance sheet rather than their P&L?
Sure, Debbie, I'll answer that in a different way. Clearly, OEMs could help their customer a lot because one thing they could do is they can look at existing supply contracts and rephrase it or redesign it, because the new lease standard ASC 842 require lessees to allocate the consideration, the lease payments, to three different buckets: the lease component, non-lease component, and non-components, right? And they are supposed to allocate the price to each of those components based on standalone price. So historically, since no one really worried about a lease and non-lease component, all they worried about is it an operating lease or a capital lease? And if it was an operating lease, everything flowed through the P&L. So no one really wanted to split the lease and non-lease components. So the new standard required that to be done. There is a practical expedient that the lessee could choose to combine lease and non-lease components. So clearly, OEMs can help their clients to structure the lease agreement in such a way that it is easy for the clients to implement ASC 842. Another thing is, like, if the clients decide, okay, they don't want to combine, or they don't want to use that practical expedient of combining lease and non-lease, then they should be able to do that if they're able to get the standalone price for the services. And the balance sheet impact of that is, if you combine lease and non-lease component, your liability is going to be higher because you're combining that and you're carrying it as a liability and a related right of use asset, right? So if you have a current ratio or some covenant that you have to meet with your financial institutions, it might have an impact if you combine the lease and non-lease components. So the OEMs could help their clients to redesign the lease agreement and make it easier for them to implement ASC 842 and reduce the impact that it would have on the balance sheet.
So probably along the same vein, I'm thinking that, there is a date at which you have to start reporting. What happens if you're the customer, you're using the asset, and you've got let's say a 15-year lease, and let's say you've still got 5 years to go. What's the expectation there? How do they make changes? What do they have to do to their equipment that they already own?
Sure. So again, there are a lot of practical experience. Obviously, FASB was trying to make it easier on the companies to implement the new standard. Now, in the scenario you talked about, Debbie, like let's say it's a 20-year lease, 15 years is done, and effective 1/1/22, there's another 5 years left on the lease. The lessees, two things. One, they can use a practical experience. They don't have to go back to the lease commencement date and see if there are any costs to be capitalized. If the classification between finance and operating lease was done correctly, obviously they need to see if it was done correctly because it should be consistent with ASC 840. And if it was consistent with ASC 840, they don't have to remeasure that or assess the classification upon implementation. But what they still need to do, Debbie, is for the remaining 5 years, they have to do what is the present value of the lease payment and carry that liability and the related right of use asset in the balance sheet effective 1/1/22. So they cannot escape, like the comparative period, that is 2021, can be on ASC 840. They don't have to convert that into ASC 842. But going forward, they have to remeasure the present value of the remaining lease, say 5 years, and then carry a related right of use asset in the balance sheet.
So again, no way out. I'm thinking, is there an opportunity for our equipment customers to go out there and get all of their non-balance sheet style leases sold now, because the reporting and accounting is going to they'll be able to bed in that old standard up to the end of the year, and that's really not the case.
Not the case, because what happens is now with the new standard, even if it's an operating lease, it has to be on the balance sheet, right? So, and effective 1/1/22, you have to remeasure anyway, in the sense you have to carry the right of use asset based on the remaining lease payment, the present value of the remaining lease payment. So and another thing is ASC 842, you should have implemented ASC 842 correctly. So if under ASC 842, it's an operating lease or a capital lease, then you don't have to remeasure that. But either way, you're going to carry the asset in your books as a right of use asset. So you may not really have any benefit out of trying to hurry and enter into a contract before 1/1/22.
All right. So I think, if we take a step back and look at what opportunities or what risks or what considerations are there for the equipment manufacturer in terms of their sales cycles around this, is for them to understand that the way the new standard is going to be applied, and their customers, they're going to have to stop talking about putting these assets on the balance sheet. And if a customer asks, they really have no option, but that is where it's going to have to reside in a large majority of scenarios. Is that right?
That is right, but clearly they could help their customer in implementing the ASC 842, because it could be very challenging for many clients, especially if they have an existing supply contract where they didn't, like I said, allocate the consideration with lease and non-lease and non-components. So clearly the OEMs may have to reach out to their clients, if the clients are not already reaching out to the lessors, and talk about all of that and see how they can redesign the lease agreement or the supply agreement. And the sooner they do that, the better, Debbie, because effective 1/1/22, it's not something like, okay, yeah, you just start posting journal entries. You need to see whether you need lease accounting software. You need to choose one. So all of that would take time. You need to look at all the agreements. Some of the agreements you would have thought it's not a lease agreement, but if you look at it, maybe you have a right of use asset and it would potentially be a lease agreement than a supply or service agreement. So one thing, the private companies, the advantage they have is the lessons the public companies learned. So the private companies can use those lessons, I guess, in their implementation. And one of the lesson was, it's never too early to start, like, and completeness, like to get the complete portfolio is a big challenge. So the sooner we start, I mean, the private companies start, the better.
And it does strike me, although we've been talking about looking at from the perspective of the OEM or the equipment manufacturer and what they're talking about with their clients. But if you're an equipment manufacturer, you've probably got all your own leases that you've got to worry about too.
Definitely,
so,
yeah.
From a addressing the change perspective, you're going to be doing it that way as well as, forward into the entire supply chain, really.
Yeah. Only good, if it's a good thing, is like ASC 842 and ASC 840, as far as a capital lease or for lessors, the change is not very different. There are some changes, but not very significant. They have tried to mirror or use ASC 606, the new revenue recognition standard, to apply to the way the lessors account for their leases. But not much of a change for lessors. A lot of change, obviously, for the lessees.
Absolutely. Yeah. Okay. Well, thank you. I mean, this has been really insightful, and it's really important, for us when we work with the equipment makers, that we can provide some extra value with the understanding of how something like this, and being part CPA, part tech. We have the ability to merge the two, and it's great to be able to talk about this. So yeah,
Debbie,
fantastic. Thank you.
1 minute, if I could tell you about SIkich. I told we do have a team. Just wanted to take not more than a minute. At SIkich, so we have a lease implementation team. We have a tool that we have developed. It's a SIkich lease template or lease tool that we have designed, and we think at least 90% of the private companies should be able to use a lease tool. So we help, we have split the lease implementation to 3 different phases. Like phase 1 is helping our client with identifying the lease, identifying all the contracts. Phase 2 is helping them with gathering the data. There are a lot of data points to be gathered from the lease documents, helping them with that. And then the third one is obviously implementing the lease standard, including monthly journal entries, financial statement disclosure. So we could help our clients in any of the phases or all 3 phases. So just wanted to share that with you.
That's great, and I would add to that, of course, because we're specialists in business applications, where ERP systems that have asset modules. So we're well versed in implementing and rollout of those sorts of pieces of the prepackaged business applications as well. So, if you are wanting to take it from a how to migrate perspective, as well as how does it work and how does it get handled within your ERP. So, Michael, I think we're good.
Thank you, Debbie. Michael, you're muted.
That's the quote of the year, right? Yeah. Sylesh and Debbie, thank you so much for being here today. Really appreciate it. Debbie, thank you for taking over my role today. Really appreciate it. I love a good break. So thanks again for being here. Like they talked about, you can find more information about all the services that we have here at SIkich at www.sikich.com to learn more. I am sure that Sylesh and Debbie would also be very welcome for you to contact them directly in their LinkedIn profiles. So feel free to do that as well. Thanks again for being here, and we'll see you all next week. Bye-bye.